Hello, this is Dr. Paul Cottrell. I'm recording this on August 15th. Thank you for joining. We're going to be talking about the markets, some news that has been transpiring throughout the week, and my perspective on the S&P 500. So let's start with my perspective on the S&P 500. It closed at 7,785. It's a little bit bubbly, I would consider. If you are invested in the broad index, you might want to put about 5, maybe 10% in cash. I have a year-end target for the S&P 500 at 7,800. It could go to 8,000, but there's an increased chance that something negative in terms of the AI trade is going to manifest. Maybe in Q4, maybe in Q1, maybe even in Q2 of next year. But in the semiconductor industry, the tech industry, that bubble was starting to deflate throughout July, but there's been new debt issuance for NVIDIA, additional sponsors of the debt through Goldman Sachs and BlackRock and some others that are increasing now this bubble. So there was a bubble that was emerging, and then it started to deflate in July, and then now it's starting to reinflate again. So I'm a little concerned about the over bubbliness of the broad index. I continue to go up and everything may be hunky-dory, but it is prudent to have a little bit of cash on hand. Now, once the sell-off does happen, that's when you redeploy the cash. And that way you're getting a better position in. So roughly 5 to 10% is probably the way to go with it. Support levels for the S&P 500 are at 7,600 for near term, then about 7,200, and then 7,000. Very strong support level at 7,000. Technically, it's around 7,000. 7,020 or so. So that's my just overall broad picture of the broad index. In terms of oil, the straight, if there's no resolution positively through another MOU or some sort of completion of operations peacefully and a flow of oil will stay elevated above 79.62. If we do hear something that is positive and more oil tankers are flowing, then we're talking about a low 70 handle, potentially even $68. So around 68 to about 72 maybe. But the probability of that anytime soon, I think, is somewhat small. So we may be seeing the anchoring of a higher oil price. What that means is that cost of gasoline is going to go up. The cost of other goods will eventually start to rise. So there's going to be an inflationary problem here. In addition, other important materials that are coming from the energy industry, like fertilizer, will be in need. There will be short supplies. And our reserves for oil, our oil reserves, strategic reserves, are depleting around the world, not just the United States. So the shock absorber is starting to wear out to be able to cushion the problems that are happening in the Middle East. So the problems that we've seen in the last few months because of the war are going to accelerate and be most likely at a higher magnitude in society. So keep that in mind. But before we go to, I'm going to play a clip from CNBC talking about market bubble fears. But before I do that, please go to my store, the-studio-reykjavik.com, and get the great supplements that I offer. These are supplements that I take regularly to help slow down the aging process and to get healthy. Magnesium and zinc helps with your brain function and your immune system. Olive leaf extract helps with your immune system and cardiovascular system. It brings down inflammation and also helps to control your lipid profile. Clarity factor. Clarity factor helps to get rid of that brain fog, allows you to concentrate on tasks, and over time, you're going to improve your dendritic connections. Your neurons will be connected better. You're going to have a better neural network, and that will allow you to think faster and have better memory. It's a very powerful neural stack. Take it every day. Drink it with filtered water. And Goodnight formula. Goodnight formula will allow you to get into 3 to 5 cycles of REM sleep and deep sleep. So you're detoxifying your central nervous system, consolidating memory, and you'll be well rested. When you do that regularly, you will have better brain function, and you'll be slowing down the aging process. Goodnight formula has tryptophan, melatonin, GABA, and passion flower. All right, let's start with CNBC with market bubble fears.
Such a fun, fast, and intelligent way to launch online.
Well, joining us now to his take on the markets, Wall Street veteran Chuck Cloud, the man, the myth, the legend, is chairman and chief investment officer of Cloud Capital, was one of the few, select few to accurately call the dot-com bubble. One of my colleagues at Merrill Lynch in the 80s. You've been in the business 59 years.
Good number.
Me, 45. And in my office, people knew of a guy. I mean, they were all screaming Eagles in my office. Jack Joyce, Jared, and then all Boston College guys. That's why you were revered. I think on One Beacon Street office, and
It was still a good office.
you had a great run at Merrill. That I think till 1999, and the run continues. But you're never on TV.
No, I haven't been. No,
I don't know. And your ETFs are killing it too.
they go well. Yeah.
Well, let's talk, since we said that you correctly called the dot-com bubble. You'd be good at calling this bubble, and you don't think it's a bubble.
No, not in the traditional sense. So people always think they're going to relive a recent experience, and the market always has something else in mind.
It barely rhymes.
Yeah, it does. It does. I think there are a lot of market and economic pressure to some short-term interest rates. The market wants interest rates to be lower. If we didn't have a Fed, if the Fed wasn't there, short rates would be between 1 and 2.
And you think that's your greatest call, was the secular decline in interest rates?
Interest rates, yeah. I made an entire career, Joe, on one call, and it went away for a while, but now I think it's back. There are 3 reasons. One is, in fact, if you look at just what the capital markets are telling you, look, the Fed cut the size of its balance sheet by a third, and the S&P was up 2,000 basis points. If you remember, an awful lot of high yield bond funds raised hundreds of billions of dollars in the late teens, and they'd starve in the teens. So interest rates were never more than 2%, and they never deployed that money. Spreads never widened out. Triple B minus spreads never got above 100 basis points, not for a long period of time, and they're 93 today. And then third, the dollar's supposed to crash, and it's not. It's sort of trading in the middle of its range for the last 10 years, and you have a third of its range for the last 30 years.
Very orderly.
I think there are three. The question is, interest rates and inflation went down for 40 years. Then, of course, COVID upended the whole thing. The question is, why did that happen? What are the reasons? And have those reasons changed? And I would argue there are 3 reasons, and they really haven't changed. In fact, they become more deflationary as we're going into the 30s. The first, the most important, is demographics. Demographics are probably the strongest reason why the yield curve is where it is. It's for a simple reason: as societies age, they save more. People, they're concerned that baby boomers, as they retire, will cut the labor force, and interest rates will shoot upward because of labor costs, and that leaves out part of the equation. When you retire, you stop spending. You don't buy houses. You don't buy cars. Older populations save more. Japan's the best example of that. In fact, if you look at Germany, Japan's been, I don't think the JGB's seen positive interest rates for 30 years. In the case of Germany, in 2013, by the time of the Greek debt crisis, Germany's savings began to exceed investment, and the Bund hasn't had positive interest rates. Italy's economy is no higher than it was, no larger than it was in 1999. And Germany's been actually contracting. But we're at that point right now. And that sets up a number of important things. One is right now there are $170 trillion of financial assets in the United States, and the economy is 30 trillion. And it takes a lot of puffing and puffing for a $30 trillion economy to sustain high interest rates on $170 trillion of financial assets. And the point is that if interest rates start to rise, defaults start to emerge. And we're in a fractionalized banking system, so defaults stop credit. And that's kind of where we are right now. Now, I think the reason why I say that affects short-term interest rates is that what the short-term interest rate is, the deposit rate, it's basically the price of financial sector liabilities. It's the price of a deposit or commercial paper or something like that. And if you're in a contractionary debt period, the financial sector is going to shrink. It's going to become smaller, and we're already beginning to see that. Banking consolidation. If you start to liquidate your liabilities, the price of the financial sector liability will decline. Now, if you look at the debt stock, people forget the government debt is higher as a percent of GDP, but private debt, which is a larger aggregate, government debt's maybe 37 trillion, private debt's roughly 50, but that's contracting. Household debt now is contracting at 2 percentage points a year relative to GDP, and business debt is contracting also at 2% a year. And I think that's really the story. As debt contracts, it's hard for the banking system to move. It's already liquidated 10% of its deposits. And I think that's a story that will start to unfold as we go
And
through.
that will mean what?
Bullish, bullish on stocks.
Well, it is positive for stocks.
And productivity and
It says bond yields aren't going to be high enough that it really creates a tremendous opportunity. But, two gentlemen won a Nobel Prize in economic sciences. Merton Miller from the University of Chicago and Franklin Modigliani from MIT. And they came up with an incentive or an observation that I think describes the markets today. They said you can't change the value of a firm by changing the debt-to-equity ratio. If debt goes up, equity values go down. If debt goes down, equity values go up. And that's kind of what's happening today. I think what you're going to see is a massive shift in the ownership of the corporate sector from the debt holder to the shareholder. As that comes out, the cruise line industry is an excellent example of this. They were forced to leverage their balance sheet heavily during the close down period. Now, as they liquidate it, the value of the equity is going to rise. And that's where the equity market is today. I think it benefits enormously as this debt stock begins to unwind. Equity is clearly benefiting. That's really the story for this.
One of the problems with the dot-com bubble was so fragmented, so many different companies. You point, and it was, I think, something you call eyeball, that you were
right.
The promise of the future.
Not revenues, eyeball.
And now you've got 4 or 5 companies that are real, and they got money, and they're leading the way. And there's actually it's underpinned by actual financial performance, but the end result, as powerful as the technology is, could be the same, but you don't have to go through sort of the growing pains maybe in the dot-com.
Well, the entire corporate sector is generating free cash flow. That's never happened before, late in the cycle.
But you don't think, and the productivity gains from AI are going to also be?
Well, I'll tell you what's already happened. If you look at hours worked, best way of measuring labor time, they're down about 2% from 2019 before COVID hit. Real GDP is up 13%. That's a tremendous productivity gain. And we haven't even seen the real effect of AI yet.
Right.
I mean, so remember, productivity is profits. So,
and you don't think that AI could be a double-edged sword? Because sometimes I think to myself, we're all talking about, is there an AI bubble and it turns the wrong way? Then I think to myself, well, in success, it could also turn the wrong way. Insofar as if we have a productivity boom, what does that mean? It means more growth at lower costs. Where do you get the costs? Look around the table here.
That's us. Well, I think the beauty of a democratic capitalist system is you always find something else to do, right? And that's happened throughout history. Remember, agriculture was 48% of the economy at the turn of the century. and it was 4% coming out of the century. So I'm not worried. I am worried about the labor force. It will have an effect, and we're already beginning to see a political snapback on that. But I don't think that's going to stop the dynamic that we're seeing right now. Now, when you look at the hyperscalers, I'm not sure anybody's going to make money because you're a hyperscaler. But as a hyperscaler, you have the advantage that the two companies that had the operating system, there are only a handful of companies that survived the dot-com boom to become even larger enterprises. Apple and Microsoft were two. And the reason is they had the operating system, the way you access the internet. So they created the software that allowed everybody to do that at almost no cost. You know, Netscape, Microsoft ended that situation in 6 months. And I think that's the situation today with the hyperscalers. They may not make money on the large language model, but they'll throw out software packages at very low cost. And that's why they're so powerful.
Hey, it's Ryan Reynolds here from Mint Mobile. Now, I was looking for fun ways to tell you that Mint's offer of unlimited premium wireless for $15 a month is back. We made these.
All right, now we're going to play a video from Bloomberg that's about inflation isn't the biggest risk for markets. I think it's the CEO of BlackRock that's talking. But before we do, please go to my store, the-studio-reykjavik.com. Get the vitamin D3. Vitamin D3 is dual purpose. It'll help with your cardiovascular health, help with building denser bones. It'll help to improve your immune system. And vitamin D3 is a gene expression cofactor to allow your cells to operate properly. Structural nano silver lozenges in orange flash and also in manuka honey. Very important for the allergy season, the cold season, even if you're working in the yard or cleaning the home. It's really important to take to protect that oral pharynx. And it will neutralize because it has the structural nano silver. Digestive enzyme complex will help the health of your pancreas. It reduces the load on your pancreas so you can digest your foods. It has the enzymes that you need to break up the proteins, the carbohydrates, the lipids. So you're absorbing your nutrients more efficiently and you're reducing the stress on your digestive system. Digestive enzyme complex also has bromelain, and bromelain helps to break up clots. And if you're 40 years of age or older, get vitamin B complex. Vitamin B complex will boost up your energy levels, rev up your cellular metabolism, and protect your neurons. So please go and get those great supplements. Use discount 5. You get $5 off any order. And a great way to slow down the aging process is to continually use these supplements. So please go to my store, the-studio-reykjavik.com. The link is in the description. Get healthy.
We start with the bond market caught between fears of inflation and long-term fiscal risks. Rick Reeder is BlackRock's Chief Investment Officer of Global Fixed Income and head of the Global Allocation Investment Team. Rick, we got CPI numbers this week, and there was good news in the fact that they're not going up. On the other hand, it's not 2.0 the way we've been promised. So which is more important, the good news or the bad news?
Well, I will say markets have been more nervous about this number. And I would think there was a collective industry-wide sigh of relief when this number came out because it wasn't, this is one of those numbers, if it comes in high, then all of a sudden now you put the Fed in clear hiking mode. And, starting to see consistent numbers. So if you go back into the last 10 numbers that we've gotten in core CPI, 8 of the 10 have been 0.2, rounded or below that. So it's still a bit elevated relative to where the Fed's long-term objective is. But I think the markets felt pretty good about, we got through it, and it wasn't that high. Then if you go through the component parts, otherwise, it was a number pretty close to expectations in almost every regard. You are seeing still things like lodging away from home, hotel, airlines. You're seeing in leisure experiences, think about the World Cup effect and otherwise, you're still seeing some pricing pressure around that. But overall, it was an okay number. But yeah, we're certainly not a target yet.
So pull back a little bit and give us a longer term view over the years of how it's bounced around and where we are today compared to where we've been.
So, the big deal for me is the Fed's mandate is price stability. It's not 2. But you'd like to get it. There is real efficacy around 2% is a normalized equilibrium for what an economy should run at. So you want to get to that number. We haven't gotten there in a long time. By the way, you can take the 2 decades before, it's pretty hard to get it as high as 2. You're in the ballpark today. And when you were running, certainly post-COVID, you're running at numbers 5, 6. That was scary. But if you look at inflation expectations today, you think about where we've come from, it's pretty stable, particularly when you've got an economy that's running with a lot of debt on it. That the thing you really can't have happen, you can't have a deflating dynamic because it enhances the true cost of the debt. Today, I would argue it's a number we'd like to see a little bit lower, but it's certainly not daunting by any stretch relative to anything we've seen in history.
So take COVID out of it for a moment. Go back to like 2024, for example. Where are we in core? What's the trend line?
Yeah, so the thing I find interesting is that it's Chairman Morris is focused on the left side of the decimal place and the right. And I think you have to take that to heart. Meaning if you're in and around the 2s, you're okay. But when you actually zoom in closer, what the markets tend to focus on, there's this maniacal focus on the right side. And since certainly over the last year or so, the trend is pretty good in that it's coming down, but it moves around. And the markets tend to focus on the 0.1% in terms of these movements. By the way, I always get a kick on the first thing I saw this morning while Chairman Morris talked about the left side of the decimal place, and the number was it printed at 0.2154. And people talk about the rounding. You think about for a broad economy like this, does anybody really care about the 0.5 other than the market participants do? So, part of when you zoom out and you say, okay, that's we're in a pretty good place. We'd like to see a trend lower. For me, I actually think we are trending a bit lower. We think core PCE by the end of the year is around 2.8. Next year, we think it gets to 2.5. And core CPI is running lower than that. Core CPI is running at 1.6. The last 6 months, 2.4. When you strip shelter out, it's actually running at about half that. So not bad. I'm pretty relaxed about where we are. There are other things I worry about. But I don't think that's going to be the thing that disrupts the markets.
In fairness to some of the commentators and analysts, I understand Chair Warsh has said we care about what's left of it. He also has said we're not done yet. I mean, if he really is just happy with the left side and given the numbers you just gave us, he would say mission accomplished, job done.
So I think there's a real nuance to that. And I think what the Fed needs to accomplish is get to that 2% number. But that 2% doesn't have to happen today, it doesn't have to happen next week. That is a long run number. And I think, quite frankly, if you are any head of any monetary policy authority, you have to be committed to that 2 number. The long end of the yield curve, every tick of it is dependent on how you articulate that thesis in terms of where you're trying to get to. It doesn't mean you have to raise rates to get there. And I think why these task forces are a very elegant way to get there. These are complex issues. When people ask, are you restrictive or not? On housing, you're clearly restrictive. You have a dormant housing market. Then you look at the amount of spend on CapEx. Like we're not restrictive of that. But you think about what would you have to move rates for the big hyperscalers not to spend on AI? You'd have to raise rates hundreds of basis points to get your IRR to a level that didn't make sense. So I think he is committed to it. I think he's going to think about the tools. You have the balance sheet, you have the money supply, you have a lot of tools at your disposal. Raising the overnight funds rate, in my mind, is not a terribly effective way to bring that number down. And I think if you really think about it in a sophisticated way, which I think they will, what are the tools and how do we get there and what's the time frame to try and achieve it?
So you say the long end of the yield curve really needs to believe the Fed, monetary authorities. If you look at what happened with the 30-year yield during and after that news conference, they were not buying it. It went up to the highest level it's been since 2007 or something.
So I think it's dead right. I think there are a couple of things to think about there. One, he didn't say hike, and I think the markets, the back end of the curve was like we could get a hike here, which would obviously show maybe a stronger near-term commitment to inflation. So there was a little bit of that. Second thing that I think proved it to be a bit untethered was this idea of, gosh, we didn't hear a lot of the metrics. Markets want to hear the reaction function. And how are you going to interpret data and then how will you react to it? I don't think you need more forward guidance. I think actually pulling back on forward guidance is a good idea. I don't agree with the ethos that people have put out there that less forward guidance means more volatility. Actually, if you go back to 21, 22, there was a lot of forward guidance. It wasn't right. As long as the markets understand and can interpret, here are the metrics you're looking at. Here's what your reaction function is going to be to the data. And I think it's quite sincere when Chair Warsh says, let the markets determine where should you be and then they can react, and that's a good piece of data for the Fed. So I think that's really important going forward. But I think the long end of the yield curve is a very important thing, how you manage that. And, oftentimes I think you need to use the balance sheet to actually keep the long end down, and we'll see how that goes.
The markets certainly react to what they think is going on in monetary policy. Are they also taking into account fiscal policy? And how big a risk is it that actually we won't be able to pay all these debts back? If you look at the term premium, for example, how big a factor is that in keeping things above to the right or the left of decimal point?
David, I actually think you hit on exactly the right point in that I think the markets will talk about on the day that maybe the long end backed up, and what does that mean for credibility? I think that was overstated and unfair. However, you do have something going on that we have, not just in the US, you have fiscal burdens that are significant. And by the way, alongside of the amount of financing this week, it was 673 billion of US Treasury debt. Which I thought it was like issuing Indonesia in a week. It's an awful lot of debt. Plus, you have an immense amount of supply coming through that is AI related. So you're pushing into the system an awful lot of financing. To me, that's why real rates are pressing higher, is the cost of finance is going up, driven by fiscal deficits around the world, not just US, but also we've got to push a load of financing in the market. And the markets are saying, okay, these real rates are attractive, but boy, maybe they have to back up a bit more to get all this financing done. And that to me is a big one.
Give us a little more detail on how you are balancing your portfolio. And I took a look at some of the numbers. It looked like high yield and securitized you got a fair amount of, and there's some other stuff.
So my fixed income portfolio, so BINC is our big ETF. Bonds are very different than equities. In bonds, my upside is they pay you back. So I know I just got to create a portfolio of people that is as boring as possible, it's as stable as possible. What is incredible about today's environment, you can create almost a 7% yield. So we're running about a 680 yield at an average rating of A minus. And by the way, with interest rate exposure that's under 3 years. I've lived much of my career never being close to decades for not being able to do that. So then what do I do with it? High yield, emerging markets, some securitized assets. I own more Europe than the US. And I just try and keep the quality of the portfolio in good shape and diversify it like crazy. And today, you don't have to stretch because these real rates are so high. A high yield should be trading 150, 200 basis points lower in yield. It's not because we have real rates high because we have an inflation issue or we have these real rates that are which make corporate investing pretty attractive today.
Gusto is the best choice for small business payroll. It's fast. It's trusted. It's a great value.
I'm concerned about how oil being elevated and fiscal debt from the sovereigns is driving up the cost of living. And if that's the case, then bond issuance are going to have a higher yield to find a buyer. So that means that the whole yield curve is going to go up. Now, textbook thinking is that when the Federal Reserve lowers rates, the yields should go down. But if it doesn't solve the fiscal problem and it doesn't solve the oil problem, then yields would probably go back up. So we most likely, when the Fed does intervene, maybe at the end of the year, it'll drive the front of the curve down, but keep the mid to tail end of the curve elevated. So it's going to be more heavier sloped, not a shift. So your 10-year bonds are still going to be at 4.6, maybe even 5. A lot of people are saying that 10 years is going to be at 5 and the 30 years is going to be closer to 5.5, maybe even 5.8. So now historically, we're going back to pre-Lehman days. So this whole epoch, this whole landscape of low interest rates for mortgages and a lower yield curve has been because of Lehman. And we are now going back, mean reverting back to a pre-Lehman time where there's higher interest rates. Problem is that our debt to GDP is much higher now because of COVID, because of Lehman, because of the war. So we're not on the same footing as we were in 2006 or 2001 in terms of debt to GDP. So I'm a little concerned about this. There's a little bit of instability in the actual debt market. And will individuals be able to adjust their life relative to these higher interest rates? Please go to my store, the-studio-reykjavik.com, and get the probiotics. You can get it in a powdered version or in the Bitchute version. A good probiotic is going to help with your gut biome, allow you to absorb your nutrients better, improve the health of the mucosal layer and the gut lining. It'll increase your concentrations of IgA, so your immune system and your gut will improve. Your metabolism will improve. The communication between your gut and your liver and your gut and your brain will improve. You'll be able to sleep better, consolidate memory, and detoxify your central nervous system with a better gut, because a better gut biome is going to allow you to get into the 3 to 5 cycles of REM sleep and deep sleep that you need regularly. In addition, you're going to be able to improve your skin. So good gut health starts at good health starts at the gut, is what I wanted to say. So please go to my store, the-studio-reykjavik.com, and get the probiotics. Now, I also have gladiator barley and heirloom barley. They're very similar, but there is one difference. So let's start with the heirloom barley. Heirloom barley will detoxify your body, bring down inflammation, soak up free radicals. Gladiator barley will do all that, but it has one added benefit, and that is to build muscle. So do some resistance training, build that muscle, take the gladiator barley. If you're not wanting to build that muscle, just take the heirloom barley. But by detoxifying your body, bringing down inflammation, soaking up free radicals, you're helping your immune system, you're helping your endocrine system, you're helping your brain function, cardiovascular system. So it's really important to take every day, either one. But if you're taking the gladiator barley, make sure you do some resistance training to build that muscle. And when you build more muscle, you're also helping with brain function. So please go to my store, the-studio-reykjavik.com. Use discount 5 and you get $5 off.
As you write, after months spent striking each other with bombs and missiles and arm wrestling over ceasefire terms, it is clear neither side can produce a decisive victory. So dare we use the term forever war?
I think we might. And I think part of what we have seen is that this isn't just a single conflict. This is actually part of a broader conflict, a broader cycle of rivalry and enmity that, frankly, we saw the start of this conflict back when Israel and the US bombed Iranian nuclear sites in 2025. And so we're seeing this continuation of a conflict that cannot be won militarily. There's no way to actually have a strategy that ends this. And even things that might look like an end are really just opportunities to sit back, rebuild, reload, and get ready for the next round. That's what we've seen already. And unfortunately, that's what we're likely to continue to see if history is any bellwether.
Becca, how much of it is not understanding the mission, or maybe the United States? I thought this was about denuclearization of Iran. We've gotten very far away from that. So is that part of the problem? What's the goal? What's the end game?
That's a great question, and I think that is absolutely part of the problem. If you look at the history of protracted wars, which we are making a call that this is, so often having different political aims that cannot be quickly and easily met and often change over time make it harder to find a diplomatic resolution. And that in itself continues to fuel these wars and make them continue. And I think that's very much what we're seeing here, where initially some of the objectives that the US put out were things like regime change. Then it turned into Iran's defense industrial base degradation. And now it is very much much focused on denuclearization, but at the same time, a lot of the actual emphasis of action is on the Strait of Hormuz instead. So we are seeing this vacillating set of objectives that makes it really hard, particularly when you compare it to what Iran's objective is, which at the end of the day is just survival.
Your projections are pretty scary here in this essay. Becca, as you already mentioned, the ongoing war will see repeated cycles of fighting, but you go on to say each round of violence will be bloodier. You see escalation, not just longer endurance, but escalation in this conflict.
I see adaptation. I think this is one of the things that happens when you have these pauses and these opportunities to essentially rebuild and sit back and say, what is my adversary doing? What strategy have they adopted? And they try and change based on that. This is very much what we've seen in places like Ukraine, where Russia and Ukraine have innovated and adapted to each other's, different tactics and strategies. And that has, while it has kept Russia from overrunning Ukraine after its wanton invasion, it has also fueled and continued the war. And I think here we are already starting to see that, where you can see different phases of this current US-Iran conflict. They are changing in emphasis, where the focus is on different geography, different domains, different tactics. And I think we will continue to see that as things go on. So we're not necessarily saying that there's going to be a sharp escalation, but we are going to see changes in tactics. And sometimes those can be very much read and perceived as an escalation.
It's interesting, Becca. We've had folks on air and talking to them and said, well, it's about time the U.S. did something. This has not been a 1 or 2 year thing. This has been going on for decades. The animosity, their words, from Iran to the United States. So it is complicated. If you take a look at the history between the United States and Iran, does that just mean that it's going to take a while to figure out the way forward?
Yeah, it absolutely would. And it will require direct talks at some point to actually have true diplomacy and true negotiations. And thus far, the preference has been for the US and Iran to act through third parties. And that might make sense when we're trying to negotiate something like a ceasefire or an interim pause to the fighting. But at some point, we are going to need to unpack a lot of these problems and find ways to do true compromise. But I think another thing to note, as we are talking about, is the United States trapped in a potential forever war, is the potential for this to go in a few different directions. The United States is remarkably good at war initiation, that is starting wars, but it is notoriously bad at war termination. Oftentimes you see that the United States doesn't get scared, but they do get tired. And eventually there is the emphasis on just walking away. And that is something that we could see President Trump do, but that is not going to resolve the underlying issues and therefore still set the conditions for continued conflict.
You see why Becca was so instrumental in planning and wargaming. She was at the Pentagon, and we're so lucky to have her now at Bloomberg. Part of your charge, Becca, is geoeconomics, and I'm wondering what you're expecting this week. We talked about this a bit earlier with the Treasury Secretary promising this 1-2 punch, not constant kinetic action, but in fact, an economic stranglehold coupled with the blockade in the Straits. Does that lead to a breakthrough? This waiting game leads to what?
I think it leads to more of the same, in part because it's going to take time for some of these economic tools to actually have an impact. And that sometimes runs counter to the military tools that they are relying on for some of their economic strategies. Here, I'm really referencing the blockade, where we have seen all of these U.S. ships at sea for months and months on end, with large discussions over, frankly, how sailors are able to maintain their mental health and their well-being. And that means that if the blockade is going to be in place for a really long time, there are going to be larger readiness issues that the U.S. military is going to need to contend with if it needs to be in support of some of these economic strategies.
Which leads me to ask you, in your story, you write, protracted wars tend to expand either geographically or in the number of belligerents. I mean, we've already seen other areas of the Middle East get involved in this. Does this continue to broaden in your view?
I think it most likely does. It doesn't necessarily mean that it broadens entirely all the time, but I think we've already seen, the Red Sea start to become an area of geography. We've seen the United States fire on ships as far as the Indian Ocean and part of its blockade enforcement. So again, if the emphasis is on these economic tools, we might see the blockade go further and further out of the Middle East to try and get after, Iranian oil traversing around the globe. So there's an opportunity for expansion. But I mean, not to be too gloom and doom, even though that is my charge, if you look at the history of world wars, this is often how they start. They expand slowly and then all of a sudden.
Well, the references to history here is more necessarily important.
This is something we talked about.
This is what I've been saying for a while. There's a curse coming. If we don't solve the problem in the Middle East by 9/11/2026, that's coming up, there's going to be a 2-year curse. And you can see that all these variables about the economy, about health, about the climate, in terms of debt in nations, in terms of personal prowess in the economy, all of these are coming to the fore. They're going to lead to an emergent property where there's going to be a lot of stress. So it's not just geopolitically, but you can see it economically starting to happen. You can see it socially starting to happen. Are we approaching the fall of the empire? I would say that there are some pieces of evidence to suggest that that's what's happening.
Like, does this become a world war? I mean, China, I think about the role of China, the relationship China has with Iran. Like, how do you guys talk about that a lot? Is the government potentially thinking that this is where it goes? US allies thinking where it goes?
I think everyone is worried about it, but I think, right now there is this commitment to try and keep it as contained as possible. And I think you mentioned China. I don't think China wants to join the fray in any form. That said, China is reportedly providing Iran with some material to continue to prosecute the conflict. But, again, if we see the US doubling down on economic strategies, that means that they might have to go after China in some way because they are such a strong partner to Iran. And there's an open question whether the United States wants to do that, particularly at this period of time where Donald Trump is gearing up for his upcoming meeting with Xi Jinping and wants to continue to have the level of detente that the US and China have had throughout his presidency.
It keeps coming up, and it's going to be absolutely huge if the government decides to go there with the summit on the way. We talked about swapping out the Lincoln a little bit earlier. Becca, we've got another aircraft carrier. I believe it's the George Washington that's on the way. But we've also seen a lot of equipment surged into the region recently. Bombers that are now being stationed in England, air-to-air refuelers. Are we preparing for something else during this lull?
I mean, I think there's always the emphasis on trying to prepare for what might happen, but let's think about what some of those platforms might be needed for. Those air-to-air refuelers are really necessary as the United States continues to enforce the blockade, continues to quietly guide commercial ships through the Strait of Hormuz, and they are largely doing that by air. So, those aerial refuelers are needed for that. And the bombers are a rotational presence in the UK. And so in many respects, you can read this as steady state, the same way you could read the swap out of the Abraham Lincoln for the George Washington as being part of routine operations. But we are currently in a conflict. We are currently in a war. So it is really hard not to see any of these activities as some form of preparedness. But preparedness does not mean that it will happen or that there will be, a big escalation. But we do continue to see the United States double down on being ready to prosecute the war if it needs to go hot again, but also continuing the blockade and continuing its efforts to escort the ships through the strait.
Diplomacy and concessions haven't worked. Becca.
I suspect that there's not going to be any serious escalation in the region by the United States before the George Washington aircraft carrier replaces Abraham Lincoln aircraft carrier. I don't know how long that's going to take, but that would mean that oil's probably going to stay above 79.62 a barrel for WTI. So Brent and WTI are going to stay elevated. Well, that's going to creep into the economy, and prices will go up, and that's going to affect the bond yields, and the Fed may have to raise rates on top of, to try to cushion the shock. We're drawing down our reserves. Well, the reserves are almost gone. So there's not much of a shock absorber left. So we're driving on the highway without shock absorbers. So you're going to feel all the bumps of this conflict now. Please go to my store, the-studio-reykjavik.com. Get the ashwagandha root. This will help to control your cortisol levels and your blood glucose levels. Lignans helps with the immune system and endocrine system, soaks up free radicals and brings down inflammation. And turmeric soaks up free radicals and brings down inflammation. You can take these separately, but if you add them together, they're a very powerful stack to help with the immune system, the endocrine system, brain function, and it'll help to slow down the aging process. It's really important. It's a very powerful stack. Get the ashwagandha root, the lignans, and the turmeric together. Take them daily. Slow down the aging process. It's a really simple concept. You soak up free radicals, bring down the inflammation, boost up your energy levels, and you've accomplished and nullified most of the aging process, so your tissues can heal, and you are slowing down the methylation, slowing down the change of your epigenetics that aging does. See, when you look at a patient and you say, well, what's their real age? It's not their chronological age, it's their biological age. And different tissues will have different ages. Your heart will have a different age than your brain, or your liver, or your vascular system, or your spleen, your kidneys. They all have different ages. And one way to measure is overall function. How's it functioning relative to the baseline of that age? If it's doing better than the baseline of that age group, chronological age group, then that's one way to measure, are you slightly younger or older than the average group? But another great way is to measure the telomere lengths and to measure the epigenetics of the tissue. When you get older, when the tissues start to get older, the telomere lengths start to shrink. And when you are getting older, the methylation starts to change. It starts to increase, and your gene expression moves from a youthful gene expression to someone that's older. Well, you want to keep the youthful gene expression, so you're producing the proteins that you would normally produce while you're younger. So it's a very simple concept. Soak up the free radicals, bring down the inflammation, boost up the energy levels. And then you add some other stuff that helps. Now, detoxifying your body is another very important aspect to this. Zeolite will bind to heavy metals, toxins, and chemicals and allow you to urinate them out within 6 to 8 hours. Zeolite, you can take every day. This type of zeolite you can take every day. Take 3 small drops underneath your tongue, drink the filtered water, do that every day. That's a great way to detoxify your body. But another great way to detoxify your body is to take the heirloom barley or the gladiator barley. And when you're doing that every day, you're detoxifying your body and you're getting healthy. But drink filtered water, stay away from processed foods. If you reduce your intake and you have ways to detoxify your body, to excrete the toxins, then your body is going to get healthier over time. So please go to my store, the-studio-reykjavik.com, and get the great supplements that I offer. All right, I want to switch to CNBC. Jeremy Siegel's being interviewed. If oil stays near $80, there's no way the Fed raises rates in September. Now, there is a thought that even with oil prices going up and inflation going up, that the Fed should not raise rates in an oil crisis because it may exacerbate the problem. But there are other things that are in the winds here, and that is over-indebtedness and just the overall economy is starting to move towards a higher inflation rate. UMich data came in at 4.3%. So expectation for 1 year inflation, 4.3. PPI came in at around annualized, I think it was 3.4. So we have an inflation problem.
We are back. The S&P topping 7,800 for the very first time today as earnings continue to impress. I know they impress our next guest. He's from Wharton School, Professor of Finance, Wisdom Tree's Chief Economist, Jeremy Siegel. Professor, welcome back. I did describe that correctly, right? I mean, you continue to be blown away by the earnings momentum, yeah?
Yeah, I'm blown away by the earnings momentum and continuing good news. Last Friday, we talked about, the situational awareness. What would you call it? Not a meltdown, a liquidity event. And it really didn't rock the market. That was a clearing event. And I think that gave confidence of people. There's some leverage built in there, but it's not excessive. And then the CPI and the PPI report today, this week, are actually quite good. Goldman Sachs, which is the best at looking at all the details.
Quite good. It's above the 2% target. You're at 3. You're above 3. If you just looked at the inflation data and not looked at the actual problems in the Middle East and oil, it'd be screaming that the Federal Reserve should be raising rates. So he's wrong. He's wrong. It's nowhere close to 2. Are we seeing CPI and PPI at 2.5 or 2.6? No, it's north of 3. What he's saying is, month over month, it's okay. It didn't go up too fast. Well, it's still above the 2% target. So he's putting lipstick on a pig.
The PCE deflator that comes out later in the month lowered their estimate of what the PCE is going to be, both for the CPI and the PPI. Said it's going to go up only 0.2%, and half of that, 1/10 of that percent, is that crazy portfolio management the section of the price index that is mostly due to the rise of the stock market. Certainly not a bad thing. So,
is it higher than 2%? Just answer the question. Is it higher than 2%? Yes. How much higher? A lot. So we have a problem. See, this is how inflation creeps in. And you have this, you're not paying attention. Yeah, the month over month numbers coming in a little bit better than expected. All right. But the overall annualized inflation rate is too damn high. This is why these professors are dipshits.
We got this week in terms of real data. Now we do get, of course, retail sales tomorrow.
Now think about this. Now, Mr. Bond Market, all right, knows more than Professor Siegel. And Mr. Bond Market, when they saw that data, what are they pricing the 10-year at? 4.6, 4.5. What are they pricing the 30-year at? 5.2. The yield curve is going up, not down. If it was so great, why would bond traders be bidding the yield up? They should be bidding it down. But they're bidding it up. It's going up. The overall trend is moving upward. I've been doing these shows for a long time, and I try on Sundays to give a snapshot of the different charts. And I've been showing the 10-year and the 30-year spread and the movement of those yields, and they're moving up. Not that long ago, this year, the 10-year was at 4. You've moved 60 basis points, 64, almost 65 basis points since then. And there were times where it was at 3.998. But it's now trading at 4.6. That's showing that the yield curve is moving up. Now, yes, it's moving more to a historical average pre-Lehman. So maybe there is a historical mean reversion that's taking place. But we have a lot more debt, 100% of our GDP. That's a problem. We have a military that doesn't have enough munitions. That's another problem. We don't have enough ships. That's another problem. Where's the money going to come from to rearm? So is things all copacetic, Professor? The answer is no. The 10-year, the 2-year, the 2-year should be at 3. It's north of 4. It's 4.14. So is things getting better? What planet is this guy on? And then just based on your own anecdotal evidence, when you're going to the store, do you feel that things are getting better or getting worse? When you buy groceries or when you finance a car or try to buy a home, you think things are getting more affordable or less unaffordable? The answer is no. Why? Because we're above 2%. The guy's wrong. The guy's just flat out wrong so far. And we're only 1 minute and 33 seconds into this video.
I have a feeling if oil certainly stays in that low 80s, I don't see any way that Warsh is going to raise in September and the earnings parade continues.
Oh, so his thesis is basically that. His thesis is basically this: CPI and PPI are just fine, even though they're north of 3. And we're not even close to the 2% target, but it's PCE that the Fed looks at. All right, and as long as so there's no real screaming from his point of view. There's no screaming need for the Fed to raise rates, and as long as oil stays at around 80, we'll be just fine. Well, no. Look at gasoline. Gasoline is what? $4.10, $4.20, $4.40 a gallon in certain regions in the United States, and even more in regions like California. That's not sustainable. And if it stays at those levels, that's indication that there's not enough oil flowing through. There's not enough oil flowing through to the refiners. And we're burning down our reserves of distillates and of crude oil to fill the gap. That'll eventually run out. So what world does he live in? Oh, he's one of those professors that's like, oh, the Fed, just keep on lowering rates to make the economy really good. See, we have financialized our economy. We used to be industrialized, but we've shipped all those jobs out. We don't have enough manufacturing. We can't even make munitions, enough of them. And we've financialized our economy. You could say during Clinton, maybe a little bit of Bush Sr., It kind of starts with neoliberalism with the markets under Thatcher and Reagan. So it's been an ongoing process. WTO being opened up for China. So you have, we've deindustrialized and we have supercharged financialization of our economy. What does that mean? That means that the Fed has to keep on lowering rates to keep the addiction going for the financial markets. If you don't believe me, every time the Federal Reserve says that they need to taper their, reduce their spending for buying bonds, the market has a hissy fit. If the Federal Reserve wants to bring down their balance sheet, the market has a hissy fit and starts to sell off. If the Federal Reserve says we're not going to lower rates, the market has a hissy fit. If the Federal Reserve says that they're going to raise rates, the market has even a larger hissy fit. That's who he represents. Professor of finance is not paying attention to the over-financialization of our economy and how it has affected us on the battlefield. So if he is so smart, shouldn't he have seen these pernicious things that were on the horizon? Because he's just not that smart. That's the issue here. He cares about the financialization of the economy. He doesn't really care about what that hyper-financialization of the economy does in the real world, on Main Street, on the battlefield. Being able to maintain our hegemonic power. We're not going to be able to maintain our hegemonic power just buying and trading stocks and bonds. You got to be industrialized. He doesn't represent that. Look at that little grin of his. Look at that grin. Everything's just copacetic, great. Because he's older, he's invested, and he sees that his retirement savings is appreciating. So as the sun sets for him, Gen X and younger generations have to pick up the pieces of this financialization of the economy. Just look at that grin. This is an example of how the baby boomers, in a broad brush of that generation, have created a pernicious problem in our country. And now we have to pick up the pieces and figure out what we're going to do. Because who launched financialization of our economy? It wasn't Gen X. It was the baby boomers. Especially under Clinton. And just keep on smiling. But because he's a professor, I guess in Chicago, I think Chicago. But Professor Siegel, he must know it all because he knows about economics and finance. Ask him about something about engineering. Ask him how to fix his toilet. Ask him how to build something. He couldn't do it. Bullshit. That's what this guy is. It's bullshit.
Now, the hype for September. I asked the question at the very top of the program, Professor, and I'd like your answer to it as well. Whether investors are simply too bullish. For a variety of reasons, they're justified to be bullish, but some would say, well, could have an earnings bubble, maybe this is the peak of it, and other reasons as well. Or are we not bullish enough because we actually have more staying power?
We have overinvested in AI to the point where there's going to be a burst of this bubble eventually, and there's going to be a 15, 20%, maybe even 25% correction in the broad market. Now, it's not going to last forever. I think it'll mean revert pretty quickly. But it's going to happen, and that's the reason why I'm saying put about 5-10% in cash and wait for that to happen and buy at those lows. And every day I try to give you updates of what those support levels are as this is ticking up and up and up and up. Because the circular financing for AI and the debt issuance to do the build out isn't going to last forever, because all you got to do is look at what happened during the dot-com bubble, what happened during the circular financing deals that were happening during Lehman and during Enron, with the special purpose vehicles, off balance sheet risk, and all the derivatives market. There are similarities to these. It's like part Lehman, part Enron, part tech bubble, and even part railroad boom. It's kind of all wrapped up. But just keep that Federal Reserve to lower rates, and this thing will continue to go up. What's going to probably burst the bubbles when the Fed actually raises rates? They should have raised rates earlier. Now, the Fed used to watch and look, you know what, maybe the market is a little bit too bubbly, and they would start hinting that they're going to raise rates, and then they would jawbone the market down a little bit, which was good. And if the market didn't pay attention, then they would raise the rates, and then the market would correct. We need a little bit of a sell-off in the SP500 to be healthy. Now let's see what the professor has to say.
And the earnings story than we think, along with some other issues like inflation coming down, and then the Fed eventually cutting interest rates, not raising them.
And productivity, which, as you know, has lagged the first 2 quarters of this year, but it looks like it might really.
If you have a Federal Reserve, the Federal Reserve needs to look at 3 pieces of data. It's not overly complicated. How fast is the economy growing or shrinking? So what's the GDP? What's the unemployment rate? What's the inflation rate? Now you can use different indices to figure that out. But in general, what's the unemployment rate? What's the inflation rate? What's the growth rate of the economy? If the growth rate of the economy is starting to falter, it may be prudent to lower interest rates. If the job market is starting to falter and people can't find jobs, it may be prudent to lower interest rates. The other piece of the puzzle here is if inflation is going up or down. If inflation is if it's going down but still too hot, if it's too high, above the 2% target, plus or minus 0.5, you need to raise rates. Even if you have a somewhat stagnant economy in terms of growth, or slightly positive. I think the GDP numbers came in at 1.7 growth. And the unemployment rate being, right now we're at 4.3. Let's look at the data that we're dealing with now. We have GDP at roughly about 1 point, I think, quarterly of 1.7%, or maybe that's annualized. So it's a little anemic. We have unemployment at 4.3, and we have inflation at approximately north of 3. So unemployment's low. We're a little bit anemic in terms of the growth of the economy. So that means that there's a lot of things going on in the economy that's non-productive. Maybe a lot of this investment, these trillions of dollars in investing for the hyperscalers and AI build out, is just non-productive. The Fed should start staircasing with raising rates. And what will happen with that is it will start to take the air out of the bubble for AI. The stocks will start to correct to levels that are more sustainable. And the unemployment rate will probably tick up a little bit, and we'll actually start seeing GDP probably go lower, maybe even negative. Now, to be in a recession, you have to be 2 consecutive quarters of negative GDP. That shock to the system from the Federal Reserve could be enough to actually get things back to homeostasis, where there's not overinvestment in tech and there's more sustainability with the actual equity market. And when people are a little bit fearful, they'll go into bonds, and the bond price will go up and the bond yields will start to go down. And when that happens, we're starting to stabilize the system. So yeah, we need the Federal Reserve honestly should look at inflation is more important than the unemployment rate right now, because unemployment rate is relatively low. And if you look at U6 unemployment rate, I think it's around in the 8 range, north of 8. So you have 4.3 and you have about 8.3. We can do a little bit of a shock from the Federal Reserve to kind of get people to wake up. You know, that this financialization of the market has to, you know, be reevaluated, and we need to start thinking about rebuilding, bringing back jobs. Now, people would say when you're raising rates, that's hard to do because you can't finance. But if you have a kind of a little bit of a shock to the system and a little bit of a recession, people will start to become bullish that are capitalists because they want to catch the next wave. So they're going to be a build out for the next wave. So I think if we don't handle the inflation issue, it's going to be so pernicious. We're going to look back and go, there was a missed opportunity. The Federal Reserve should have handled it better. Just like what the federal governors have said at the Federal Reserve, that they missed the opportunity when they thought that inflation was transitory during the fiasco during the Biden administration. We're losing this opportunity here. We need to handle inflation. If it's staying elevated above the 3%, is inflation going down? Yeah, inflation is going down relative to the issues with tariffs, the issues during COVID. Yeah, inflation's going down. But the thing is that it's still above the 2% target. It's not about is it going down. It's been elevated above the 2% target for many years. It's too high. It needs to be shocked. And the only way to shock it by the Federal Reserve is to raise rates and create a little bit of a convulsion within the market. But the Fed is afraid to do that because there's going to be a hissy fit and Trump's going to demonize the Fed and yada, yada. And you got people like him that are professors of the financialization of our economy. You can't win a war because of finance. You win a war because you have missiles. And what are we short on? Tomahawks.
In this third and fourth quarter, I mean, AI really beginning to come in, and AI not just causing the earnings to go up because the hyperscalers and all the spending on the infrastructure, but again, as we've talked about so many times, firms using it to reduce their own expenses, to increase the margins, which have been, pretty stagnant for.
No company has verified that their financial performance from a quarterly basis has improved because of AI. No company has been able to prove that. Now, when they want to talk a good game, so people buy their stock, they say, yeah, we're using AI to become more efficient. Really? Where's the data where you have a control, where you compare it to an era that's similar and you were doing something a similar way and you didn't have AI. Prove to the market that your company is actually becoming more efficient for the bottom line, where your return on investment or return on equity is higher because you're using AI. No company can prove that because it's so minuscule. And it's something that is going to go through not invention, but innovation. And it's going to be a slow trickling, and things will become slowly more efficient, more efficient, more efficient. And then there will be a compound effect. A little bit of efficiency year over year will compound. But big gains in terms of revenue or even net income, where is it shown on the balance sheet? Oracle's laying off a lot of people. That's because they're investing so much in the build out. Their CapEx is skyrocketed and they had to lay off 20,000 workers. Is the economy more productive? Well, the country is not more productive. Businesses aren't more productive because of the build out of these servers that Oracle's using, and they laid off 20,000 workers. So is the economy more efficient? We're spending an awful lot. Yeah, these numbers that people are talking about in the semiconductors industry and the tech industry, it's all CapEx spending. Where is the net income? Where's the real net income? Not the booking of a build out where when you actually run data through the servers, do you have businesses that are actually making money doing this? The answer is no. There's no proof of this. So it's a bubble. But at the surface, at the immediate level, net income went up. Net revenues went up for NVIDIA. So the market bids it up. I think it's trading at 127 or somewhere on there, 124. And not 124, I'm sorry, 224 or 227. It was trading at 200 not that long ago. So it's being bid up. But they're building out these chips, building out these server farms. But what company that uses these server farms, that uses OpenAI, is becoming substantially more profitable? Where's the business case? And then when you're looking at the OpenAI and Anthropic, which are the two biggest users of these servers, they don't have profitability. They spend more money than they actually make. And there is no visibility of when that break-even point will be reached. That doesn't sound like a sustained business model. It's closer to a Ponzi scheme. The Ponzi scheme of debt issuance. So just look at that face. You got, what does he represent? Financialization of the markets. He's a boomer. He's not paying attention to the real economy. Yeah, short term, these tech stocks went up. The bubble is starting to inflate again. But again, get back to the fundamentals. Are these companies really profitable? Or do they have to do these financial engineering, circular financing to keep the P&L going up? Just very one-level thinking.
Non-tech group, if you take a look historically. Now, certainly overall, and as you commented at the beginning of the program, margins overall on the S&P are at all-time highs. But if you take out the tech communication, they've been relatively stable. But they can improve dramatically if they can use, what AI is designed for, and that is to reduce costs.
So let me get this straight. Reduce cost means less workers, but your economy is going to be stronger? I don't think so. This is the problem that people are saying. How can you have a growing economy when you are to be more profitable? It's about shedding human labor. At the very beginning, these stocks will go up. These ones that figure out how to use less labor, their costs go down and their revenues, let's just stay the same, in the short term, their stock price will go up. But what will happen is that when more and more companies do that and they're laying off more and more workers, then a recession happens, revenues go down, and then the stocks get sold off. And there'll be a sell signal by the analysts for these different companies. So there's these different phases to this. There's the bubble phase where no business model has proven that this technology is good, beneficial. And then it starts to shed jobs to right now we're shedding jobs to compensate the CapEx, the capital expenditures. And then you'll have some companies that become successful in making their business more profitable by using AI, and they'll shed more jobs. Their stock price goes up. Lots of companies do this. Their stock price goes up, but then eventually there's so many workers that are laid off. We're not at 4.3% unemployment. We're at, for U3 unemployment rate, we're at 6 or 7%. And then all of a sudden GDP goes negative, and then their revenues start to go down, and the stock analysts will start sell these companies. And now we have structural unemployment. And that's the cycle. And then now you don't need as many workers, and the ones that have been laid off, how do they get reemployed? Because normally when people get laid off, it's because of a cyclical pattern. And then eventually people's buying patterns increase, the economy grows, and people are reemployed. But this whole AI issue is structural unemployment. But, why should he care? He's a boomer. He doesn't, why should they care? Why should they care? He doesn't have much life left. Who's going to be picking up the pieces are the Gen Xers. Once again, the Gen Xers have to pick up the mess of everybody.
Before, the story can continue despite whatever happens to that AI. I'm not going to, whether it gets slightly overbuilt, what kind of competition. Boy, it seems, doesn't the token decline, the stories seem to be overwhelmed always by the results and the earnings. I do not think it's inappropriately bullish at this point.
Wow. What do you like the most in the market right now? What looks most attractive to you? If you were just judging the market on a price to earnings ratio, a sector, something you think is unloved, what we're not focusing on enough, because tech, deservedly so, is sucking all the oxygen out of the room, and maybe that's your pick. You tell me.
Well, there is a rotation that has taken place over the last 6 months from what we call growth stocks to value stocks. And I think on the day that
people were getting out of Mag 7 and there was a rotation into other areas of the SP 500 going all the way back a year ago. That's 6 months. So most of the gains on the S&P 500 are not due to Mag 7.
That a liquidity event, some people call it Leopold low, after Leopold Asher Center, when he had to sell out much of his position. That was an extreme, shock on that. Now, we have really bounced back from that. But if you keep a look at the broader trend, that rotation is still taking place. It doesn't mean that, that the mags and the hyperscalers and tech are going to falter. But as I say, when I look forward to potentially as the gains that aren't accounted for on the future, I like the 15 PE stocks that potentially have gains from AI. And there's many companies, I mean, Anthropic is one of them that's listed almost every industry and how much potential gain it could get from AI, and yet has not used it yet. And, I'm not going to say specific names or not, but I think that is in the future that can continue that rotation. And those, well, by the way, those can still go up, but you can have, as we see, some of those ignored value stocks rise relative to, the winners of the last 2 or 3 years.
Finally, a platform.
That trade is being played out for a year now. Please go to my store, the-studio-reykjavik.com. Get the Boomer Boost. What this will do is help with your brain function, your cardiovascular function, your immune system, your endocrine system, musculature, your energy levels. And it'll help to slow down the aging process. It soaks up free radicals, brings down inflammation. This can be used as your multivitamin, your daily multivitamin. It has the multivitamins and the minerals that you need on a daily basis, but you get a lot of other supplements within this to help with all these different organ systems. This is super important to take. It's a month supply. Make sure you take it every day. C60 is a very strong, very potent antioxidant. Take a teaspoon a day every day. You can get it in avocado oil, extra virgin olive oil, and MCT coconut oil. Take a teaspoon every day, and by taking that teaspoon a day, what we'll do is your tissues will have less inflammation, less stress. It's going to soak up those free radicals. Your mitochondria will be healthier. It'll be producing more ATP. And when you have more ATP, the tissues are going to perform better. Your cells are going to perform better. When you soak up free radicals at the vascular level, you're reducing the concentrations of oxidized LDL, so you're reducing plaque formation. In your brain, your neurons will be healthier, producing more neurotransmitters by soaking up those free radicals, improving the mitochondrial health, and your dendritic connections will improve. You're going to think faster, you're going to have better memory. And at the basal layer of your skin, it'll improve, so your skin health will improve. Your immune system and your endocrine system will improve. So you're slowing down the aging process and helping all these different organ systems. So take a teaspoon a day every day. You can get in a 2-ounce, a 4-ounce, or an 8-ounce configuration. You get the Max 35 or Cleanse. Max 35 or Cleanse will help to boost up your innate immune system. Take a teaspoon a day, swish it in your mouth, gargle about 20 seconds and swallow. It'll improve the health of your oral cavity, your oral pharynx, maintain your mucosal barrier, and help the health of your epithelial cells. It neutralizes because it has structural nanosilver. I've been doing this protocol for over 6 years every day, teaspoon a day, every day. And what that will do is neutralize, especially during the cold season. You should be doing this every day, and it'll help to boost up that innate immune system. And use my structural nanosilver toothpaste. It'll help to whiten your teeth, freshen your breath, help with your gum line, reduce inflammation at the gum line. It neutralizes because that's the structural nanosilver. This is something you should be using every day, especially during the cold season. Get a few tubes of this toothpaste for your household. It's the best toothpaste that you can get, and it has no fluoride. So please go to my store, the-studio-reykjavik.com. All right, let's listen into the Strayer Hormuz. What's going on?
Well, now we totally control. We own, in the true sense, we own the Hormuz Strait, and we only allow boats to come in if we want them to come in. No boats are coming in. So we haven't had one boat come in since we've been there for Iran. And what it means is hundreds of millions of dollars every single day they lose. So I think we're doing very well there.
President Trump telling our colleague Alexis McAdams that the U.S. has full control of the Strait of Hormuz. Let's bring in former Air Force intelligence officer Jake Saturiades and former Trump ambassador at large and counterterrorism coordinator Nathan Sales. Gentlemen, welcome to both of you. Thanks. I want to play another clip from Alexis's interview with President Trump today, and I'll get you to break it down.
We're doing it in a very professional manner. We did it with Venezuela a little bit differently. We could go in, and if they hit, we would hit back 100 times harder.
What if it's right before the midterms? Do you care?
Well, it could be, but people are looking at gasoline prices. That's all they're looking at. They like the fact that I'm stopping this lunatic nation from having an atomic bomb.
Ambassador, how do you respond to these latest comments from President Trump?
I think the president is spot on when he talks about the economic impact to Iran of our blockade. They're losing $435 million a day, and they can't survive that forever. Our economy is the strongest in the world. Theirs is not. And so that imbalance, I think, creates an opportunity here. It's clear that diplomacy has run its course. The Iranians are not taking these talks seriously. They're never going to agree to a deal that would satisfy our requirements. We don't want to go back to war. So what's the third course? Economic pressure. We keep up the pressure. We weaken the regime. That puts us in a stronger position going forward.
All right, so squeeze the heck out of their economy. Here's President Trump on the Strait of Hormuz today.
Pretty soon I'll be declaring the Hormuz Strait a territory of the United States. They're really doing a great job. Our military is unbelievable. The blockade is unstoppable. It's a wall of steel. The blockade is a wall of steel.
Jake, what's your assessment of the president's latest comments on the conflict with Iran?
Well, Mike, I think the president's clearly having some fun with the crowd there with that comment. And I mean, he's already got the Gulf of America. So I think if you really break it down, there is, on a serious note, the best argument the United States can make is that the Strait of Hormuz is an international waterway. So the fact that no nation has a right to own or control that unilaterally is really the case that the president is making here. That is America's argument. And this is the argument that Iran cannot unilaterally control the Strait of Hormuz or charge tolls or fees or influence over this area. And the problem that we have now is that even though the United States has superior military capability in every aspect, you're still seeing the Iranians with drones, with asymmetric means, threaten any commercial ship. And that uncertainty, the concerns that ship owners have, that insurance companies have, that is what is preventing them from using that waterway. And that is what the Iranians exactly are hoping to do, is to continue to sow that uncertainty.
Picking up on that point, here's some analysis from General Jack Keane.
What they are doing is less about control, and it's more about influencing shipbuilders. Through intimidation and coercion, there's still a significant number of ship owners and ship captains, obviously, who do not want to transit the straits because of the threats from Iran. And that threat is real.
Jake, as you study this, is that what you're seeing as well?
I think General Keene's right here, Mike. And I think we have a paradox of sorts, because Iran undoubtedly is much weaker militarily than it was 6 months ago due to the campaign that's been executed by the United States and Israel. But a weaker Iran, ironically, may be more dangerous, because a weaker regime may be more willing to take extreme measures, use more asymmetric means to try to close down the strait, to try to widen the conflict, to attack U.S. allies in the region. And so this is the time where, if we look at this uneasy period where we're not necessarily at a negotiation phase yet, everything is still up in the air, the Iranians are looking at the clock and they're looking at the midterm elections, and they know that if they can drag this out, if they can sow uncertainty, if they can drive energy prices up, that they're hoping that the president's party will pay for that at the polls, and that is their strategy.
Then there's Pakistan working on regional peace. Deputy Prime Minister, Foreign Minister appreciated the positive trajectory in Pakistan-U.S. relations and underscored the importance of dialogue and diplomacy for lasting peace. He emphasized that the implementation of the Islamabad Memorandum of Understanding of 18 June in letter and spirit is the only way forward. Ambassador, as our diplomat on set, how do you respond?
Talk to the Iranians. The Iranians have been very clear since these talks started back in April with the ceasefire that they're not serious about negotiations. They're not serious about giving up their nuclear weapons ambitions. They're not serious about reopening the strait according to international law with freedom of transit and without trying to charge tolls. So the diplomacy is basically what it always is for the Iranian regime, a way to buy time. It's a smokescreen that they can use to mask their regional ambitions, to mask their nuclear program, and to mask their attempts to coerce and hold hostage international shipping. We got to go through the motions of diplomacy, but the way you make diplomacy effective is through the threat of military force, or, as we're talking about here, the threat of economic coercion. That's how you get good outcomes at the negotiating table.
Literally crossing the wire right now. Iran's foreign minister says Tehran has not decided to resume talks with the U.S. and they're talking with the Pakistanis, but it's not a negotiation. So there you go.
Here we go again.
Be sure to like and subscribe for all the Fox News latest on YouTube and catch full shows.
Please go to my store, the-studio-reykjavik.com, and get the structural nano silver gel. You can get it in the tube form or the quick dispenser called Renew. Dual purpose. You can use it as a daily skincare. It'll help to heal a wound quicker. And you can put it on your hands, lightly coat your nostrils. It stays active for 5.5 hours. Perfect for the allergy season and the cold season. I also have a new product called Super Strong Relief. This will help relieve the pain from pulled muscles, bruises, sprains, arthritis, tension headaches. It's a topical. You rub it in the area of the pain and it will reduce the pain or eliminate it within 90 seconds. It's temporary relief, but it's all natural. Please go to my store, the-studio-reykjavik.com. Get the Super Strong Relief. It's great for arthritis. Now, I want to play this video. Dan Ives is, once again, pumping the AI stocks. But like I said, there was this bubble that was emerging. Then it started to deflate in July, and now it's starting to inflate again.
Will the next wave of the tech trade be led by software or semis, or maybe could it be both? With us now is Dan Ives, partner and senior managing director at Yorkville Ives. Dan, always great to see you.
Good to see you.
What stage are we in this trade in terms of software and semis? Is it a one or the other still?
I don't think so. I think it just keeps coming down to like that software trading. We saw stocks sell off SaaS apocalypse. That was a fictional narrative, in my opinion. I think you're starting to see that prove itself out. But software is going to be the second, third derivatives of the AI revolution. So I still view it, even though chips are leading, software now is starting to get ready to go into that AI party. And I think the monetization, I think when you look at Microsoft, Palantir, those are two specifically, I think give much more validation to what tech investors are looking for.
Right, and then there is this reported interest by Silver Lake for a workday. Can you sort of go through, extrapolate what that could mean for the space if private equity is looking at a name like a Workday, an enterprise name, an HR software management name? You know, are there other names like this, and could there be other deals to come?
You know, I think when you look at Workday and you look what's happened across software, in that there's value in PE, and especially in that 415 area code, they're going to find the value. I think it does put a floor on a lot of these names, specifically relative to the sector. But then you have to see as it actually plays out, and are there more deals to actually be had? It all comes down to customer bases. The install bases are key, because data, you can talk about compute, but data is almost, that's the hearts and lungs of the AI revolution. These companies have the install bases, but there's winners and losers. And like some of the names that you've talked about, Adobe and some others, you're starting to see a separation relative to names, if it's a ServiceNow or others that will benefit versus maybe others that won't.
What do you think has been disproven since the initial IGV lull over AI displacing software? What has been disproven in that narrative so far? What have we moved past?
I think it's the narrative that software companies, that they're going to get eaten from Anthropic and the model companies. No one's going to need software companies. They're going to be disintermediated typewriter companies, word processor, VCR, however you want to think about it. Because now the monetization on the use cases, you're seeing software companies they're really key in a lot of these deals, and I think that is the shift in the narrative as you're seeing the monetization.
That's the extreme of the narrative in terms of, you know, AI completely displacing software. But is there another narrative where AI just simply at the edges takes off the need for software. Certain kinds of enterprises may adopt AI instead of going to a CRM or a Workday.
No doubt. And that's what for software companies, they can't just be on the treadmill of 2.5 speed. Like maybe they were 4 or 5 years ago. The hubris is out. And I think some of them they're going to have to do acquisitions. Or when it comes to boards and some of the decisions that they're going to have to make, do they look potentially strategically at other options? Because there's not all going to be winners. But the one thing that you're seeing in the AI revolution, the CapEx, for every dollar of CapEx, $5 to $6 multiplier across the rest of tech, a lot of that will be software, infrastructure, cybersecurity is a good example as it all starts to play out.
Is there more room for cyber as we're hearing about more and more, models getting out of sandboxes, et cetera? Do like some CrowdStrike, which by the way hit a new high in today's session, do they have the tools? Are they the answer to breakouts like those that we've heard about so far?
I think it's a golden age for cybersecurity because in our view, from everything we've seen, I think budgets could ultimately double in the next 2 to 3 years. When you look at some of the leaders, let's say with George and CrowdStrike, seeing around corners relative to agents and how you're actually going to make sure that the surface area are ultimately going to be secured, Palo Alto and others. But at the end of the day, it really comes down to surface area is increasing. As the use cases grow, so is cybersecurity. It's a good example of the derivative beneficiaries. I remember being at RSA in March, and when you go back to the spring, just the negativity there, it just shows the narrative sometimes could be wrong at that. But these companies have to prove itself out quarter by quarter.
Renewables are transforming the grid, but they can't do it alone.
I think the bubble is coming. The bubble's coming. So I'm not a big fan of purchasing individual stocks. I'm a more broad index kind of guy, commodity guy, larger economy kind of perspective. But be careful with this whole tech and AI build out. Please go to my store, the-studio-reykjavik.com, and get the collagen. Collagen will help with your skin, your nails, your hair, help with musculature, bone density, and cartilage. Take the collagen every day, especially if you have problems with your joints and you're trying to remodel it because of a sports injury or arthritis. Collagen is a great way to stack it with the collagen or the super strong relief to help to remodel the joint. It will help to remodel the cartilage and the cushioning of the joint, block some of the pain gatekeepers, NAV 1.7, reduce inflammation by blocking Ep4, and reduce the erosion of the joint by blocking MMP3 and MMP13. So if you want to remodel your joint because you have arthritis or a sports injury, take the collagen. Take the collagen if you want to help with your skin, your nails, your hair, your musculature, your bone density, and it will have the ingredients you need to help to remodel the joint too. So please go to my store, the-studio-reykjavik.com, and get the collagen. And a great stack is to stack it with the collagen. That's the end of my broadcast. Thank you for watching. Please help support the work that I do by sharing links, asking your social media to follow me, and get the great products that I offer. They're very high quality, and these are products that I use to help slow down the aging process. But it's not just taking supplements, it's also a holistic approach, and that is proper diet and exercise, drink filtered water, stay away from processed foods, learn new things, do some resistance training, cardio, heavier on the resistance training relative to the cardio. You want to do stretching and balancing exercises. All four of those modalities are really important. And get proper sleep. When you do these things on a regular basis and take the proper supplementation, you're going to be slowing down the aging process. And you won't be needing to see a physician that often. And you won't need to be on pharmacopoeia. Most of the diseases in the United States are self-induced. You can change it. And if you already have problems, you can slowly chip away and get healthier, and you won't be as dependent on these treatments from pharmacopoeia and from your physicians. You won't need it. So you have two paths. Listen to me and get healthy. Don't listen to me and have problems. It's that simple. Thank you for listening and have a nice day.